I'm Antonia Forica. I work in the Office of University Life as the program coordinator working with student engagement and operations, and I use she, her, hers pronouns. So thank you all for being here. We're very excited that you are. This event is hosted by the Office of University Life in collaboration with Student Financial Services as part of our Wellness Days initiative, which aims to promote and support the different dimensions of well-being across Columbia's community through a series of events like study breaks, fitness classes, and workshops like this. For this event, we recommend setting your Zoom view to speaker view, which you can do by clicking the view button at the top right corner of your Zoom window. Okay, and we'd like to open today's event by looking at the 7 dimensions of well-being, which I will show you here. So these 7 dimensions, as you might see, there are career, emotional, financial, intellectual, relational, physical, and spiritual dimensions to your well-being. If you haven't already, please go to the Poll Everywhere link you see at the bottom of your screen here, pollev.com/ulife100. And please tell us which dimension of well-being you're focusing on today. Oh, financial is a big one. Intellectual. I see. Oh, career. Great. Let's see what else we got. Emotional, very good. I know money is an emotional thing for me sometimes. Career, awesome, okay. Intellectual and financial are big ones. Welcome to everyone who just joined from the waiting room. Hello. There will be a chat message waiting for you, and we are at a poll talking about the 7 dimensions of wellness and which ones we're focusing on today. Thank you for your responses, and it's going to highlight this may highlight something for you that you did not expect to, so we'll see. You might relate to something else more than the one you thought of at the beginning of this session. Emotional, still financial, great, okay. So keep this in mind while we go on this journey during this workshop today. And today's event is in collaboration with Student Financial Services, and I'm excited to introduce and hand it off to our instructor, Trista, who is a financial aid officer at Student Financial Services.
Thank you so much, Antonia. And hello, everybody. I'm so glad to have y'all here today. I am joining everyone from New Jersey. Nice and pretty much local, given the Morningside campus. I know that we have people attending from around the world today. So I want to thank you, regardless of what time it is, for joining us, where you happen to be sitting. And as I go ahead and get ready to share my screen, I do want to let you know that I'm more than happy to take questions. Please feel free to put them into the chat. We'll stop periodically and take a look through them, but we do have a lot to cover in this presentation today, and I want to make sure that we have the capability to get through all of that material while still being able to answer your questions. So if things come up, please do not hesitate to ask. I'm more than happy to take questions as we go. But in the meantime, we're going to go ahead and get started on our presentation of Financial Wellness in You, Credit, Debt, and the Benefits of Borrowing. Just a brief agenda to show you what we'll be talking through, of course, credit, debt, and then how it relates to financial wellness. We'll also talk about student debt management, personal value assessments, and the benefits of borrowing responsibly. Budgeting for financial resilience, and then a little bit about what iGrad is. If I can ask, if anybody would like to share in the chat, are any of our students here today familiar with iGrad, or have you utilized it before? Awesome, awesome. I see a few of my colleagues in university life, and some of our students are chiming in that they've used it before. Great, great. So the idea behind these presentations is we try and really coalesce the information that's available through iGrad, which is the university's financial literacy platform, to give you information that is not only beneficial to you, but also that is easily accessible. So for anyone that's tried it, or anyone that hasn't and hasn't created an account just yet, that is something that's free to you through the university. And I'll share instructions in the presentation materials after this today on how you can create that account so that you have access to all of the same information that we're talking through in this presentation. In the meantime, though, my contact information is on the screen. If you have any questions, either after this presentation or you just want to get in touch at some point, give feedback, we're more than happy to accept it. So please do know that that will be in the presentation materials for you as well. And we're going to get started. So the first thing is to really understand what financial wellness is. It's really just your financial well-being. And if we look to the Consumer Financial Protection Bureau or the CFPB, they suggest that financial well-being can be defined as a state of being where you have control over your day-to-day and month-to-month finances. You have the capacity to absorb a financial shock. You're on track to meet your financial goals. And you have the financial freedom to make the choices that allow you to enjoy life. And a lot of people think that sounds grand, right? But at the same time, it's not grand when we put it in the context of wellness, right? We looked at those other 7 dimensions that we have in the whole wellness idea and how we really think about those in a much more wellness oriented fashion. Finances are no different. They relate to several different dimensions in that realm of wellness. So having that sense of wellness is really important for your overall well-being. Now, how do we really achieve that, right? To do that, we have to look to financial literacy or your financial ability. It really is the path to financial wellness, and it includes a set of skills that encompass knowing when and how to find reliable information to make a financial decision, knowing how to process financial information to make sound financial decisions, and knowing how to execute financial decisions. Adapting is necessary to stay on track. So one of the things I find most interesting is when you look at the financial literacy side of things, it's knowing, knowing, knowing. That's the skill set, right? Where on the well-being side, it's having, having, having. That's what you're looking to achieve. But on top of that, knowing, knowing, knowing is one thing. There is a critical component to consider in that side of this discussion. Financial literacy is knowing those skills, but also being able to put them into action in a meaningful way. And that's going to be a little bit what we talk about here today. One, sharing how we can robust our set of skills, and two, how we might be able to best leverage them in certain circumstances. Now, when we think about financial wellness and then integrate the idea of money management, we really just want to think about what that means, right? Managing money is about your lifestyle, your plans for the future, and your personal values. It's a very individual circumstance. And to be successful at money management, you need an accurate understanding of your current financial picture. Pretty simple, right? You can't talk about finances unless you understand what yours are. And there's several different ways that you can conduct what's called a personal financial assessment. And you'll use one that best fits your individual circumstances, depending on your knowledge influences, right? Things like your level of financial literacy and the tools available through platforms like iGrad. And also your behavioral influences, right? Your values, your beliefs, your personality, they impact our individual decisions and behaviors in all of those realms of wellness, including financial. Um, with that being said, we look to the personal finance ecosystem as a way of understanding that. It lays out the foundations that underpin an individual's level of financial well-being. It gives context to the elements that comprise and influence financial well-being, and it helps to identify what educational behavioral influences and interventions that we can use to best achieve those goals. The bottom line, using all of that, right? It's a framework, and we have to start at the beginning. So we have to start by assessing our finances and creating a spending plan that looks to help protect our interests in the future and make our money work for us, both now and later. And that's going to be a little bit about what we touch on today and how we do that as an individual instead of trying to adhere to a grander scope of what others might think we need to do. So we'll talk a little bit about credit and debt in this presentation, and really, I wanted to take the moment to define those two things. They are used often very interchangeably, but they're not exactly the same. Credit is the borrowing capacity of an individual or company, right? But in its most basic sense, it's the level of trust that a borrower must earn before a lender will be willing to lend them money. Pretty simple. You use credit to borrow money, which then becomes your debt, right? So credit is the accessibility side of things, debt is the required repayment. Now, you can't borrow most types of credit without a credit history. And one of the topics that we cover in detail in other presentations we do throughout the term include credit information. And I have some of the borrowing basics and the resources here for you in this presentation, so you can refer back to it and what goes into building your credit score to kind of build a fundamental to this conversation. Okay. Now, lenders will evaluate your credit to determine your eligibility to borrow, right? That's a pretty familiar concept. Most of us have done some type of application where we had to submit to a credit check. However, if you have it, the basic idea is they collect some personally identifying information and then review the information associated with your credit history found on your credit report to determine your eligibility to borrow and the terms at which you will borrow. So that's going to vary with each individual lender or any financial institution that you choose to apply with. Now, debt, on the other hand, that's money one person or organization or government owes to another person, organization, or government that is generally repaid with interest over an established period. And there's a couple different types. There's secured credit, which is generally going to require collateral like a house, a vehicle, or cash. And you lose the collateral if you don't pay as agreed. So a mortgage is a really common example of this. Unsecured credit, on the other hand, has no collateral required. It can often have higher interest rates than secured loans because, again, there's nothing to barter with, so to speak, in that conversation. You don't have a physical leverage. And they keep money or collateral in a dedicated deposit account equal to a card's credit limit. Usually, it's easier to qualify for this type of, excuse me, I'm so sorry. It's easier to qualify for this than unsecured cards as they typically have lower limits. Now, revolving credit, there are no fixed repayment periods associated with those types of accounts, and the most you can borrow is your credit limit. That is your typical credit card. The minimum payment is often 1% to 5% of the outstanding balance, so that will vary with each independent lender or financial institution you pursue. Noting again those borrowing basic resources that are there, you'll see this happen throughout the presentation deck. There will be links to the information that's associated with iGrad and the other organizations we were able to build this presentation from, so you can access the materials and review for yourself as well. Now, we want to think about what that debt life cycle really looks like, right? From application to actually having debt and going into repayment. Most lenders use the FICO or Fair Isaac Corporation method of reporting what's called your credit score, which is the three-digit numeric representation of the information in your credit report. They generally range from 308 to 850, and creditors report data to credit bureaus according to their own schedule, usually somewhere between 30 to 45 days on a cycle. Okay. Simply put, the higher the score, the better your credit. Easy, easy, easy. However, lenders may consider other information outside of that score, right? They're not just looking at the score, that representation, they're looking at the actual information in your credit report or your history. They'll also look at additional information that you may provide during an application. So for example, it's not uncommon for a credit agency to ask for income of a person that's applying for a line of credit. What they're looking to effectively do is establish your income to debt ratio, better understanding how much debt you can reasonably support given the amount of money that's currently available to you and the debt that you already have extended. So these are all things that could play into deciding whether or not an individual financial institution will ultimately lend funding to you in a credit-based capacity. Now, as far as actually remaining current and paying your bills, right, there's two different ways to kind of parallel current versus not current. Current is a pretty simple process, right? You take on the debt, meaning, let's say, using a credit card as an analogy, you purchase, right? You pay on time as agreed based on the information that's provided to you or the terms and conditions of your card, and then you pay it off, whether that's over one payment period or several, based on your individual circumstances. Now, to not be current, what that really means is that you take on this debt and you miss payments or become delinquent, and ultimately could go into default or charge off, with default being a potential loss of some of the entitlements and protections that you have in certain circumstances, and charge off being kind of a lender saying, I don't know, I don't know what I'm going to do about that. So they report it as a loss on your credit. And ultimately, it could be assigned to a collection account as well, which means you're going to be getting those calls that so many people have certainly shared about over social media and other platforms relating to debt collection. Ultimately, why this is important, right, is that keeping your credit score healthy allows you to borrow at lower rates. And lower rates will generally mean lower payments, right? So when we think about that in long scale, right, if we think about the amount of money that we're paying over time, credit cards are a good analogy for it because when you buy something in the immediacy of it, we know what our interest rates are and we know what the terms of our cards are to some degree, right? And we know what the expectation is to pay it. However, we are human beings and we have impulses and we have sometimes, certainly in the world we're in today, a hard time looking at long-term planning, right? The days kind of run together a little bit. So when we think about it in the maintenance perspective, putting that today framework on it and knowing that you have to be as current as possible is extraordinarily important in the long term. Now, one of the other things that ultimately impacts how successful you are in repayment is understanding your obligations, right? And to do that, you have to read your disclosures. The Truth in Lending Act, or TILA as it's called, requires that borrowers receive written disclosures about important terms and credit before they are legally bound to pay the loan. So what that means is you have a lot of opportunity to change your mind. You're not necessarily supposed to be going into any financial obligation not knowing the expectations. So, just to give an example, when we get our credit card offers in the mail, a lot of the time we kind of see this weird grid box with a bunch of rates in it on one side. That is the first disclosure in this required process, with a total generally of 3 that you'll see, depending on the type of it is. Now, there's a few terms that you'll see on there. The first of which will be an annual percentage rate, and the second, an interest rate. A lot of us have an idea what interest rate is, right? It's the amount that's charged expressed as a percentage of principal by a lender to borrow for the use of money, right? Very, very simple concept. However, annual percentage rate often can be a bit better a mechanism for understanding the totality of cost over time. It includes any other fees in the assessment of what your annual percentage rate is. So if you have a credit card with, let's say, a $99 annual fee, your interest rate, let's say, or 5, right? You'll notice that the APR is slightly higher, probably just under 6, because it's accounting for that particular fee, showing you the total cost. Okay. Your total payments, that's the sum of all the payments that you'll have made at the end of the loan, or the card agreement, whatever it happens to be, depending on that type of debt that it is. And it'll also include in those TILA disclosures other important terms such as the number of payments, the monthly payment, late fees, whether you can prepay your loan without penalty, and other really important term information associated to that product. So this is why it's so extraordinarily important that you read through that information. It really does set you up for success without having unexpected consequences. Tailor disclosure is often provided as part of a loan contract, so you may be given the entire contract for review when you ask for the TILA disclosure. Um, Credit cards, often you'll see those come in pieces based on when you apply. Sometimes you'll see it during the application process online. Certainly, if you're going for a financial product that's more like loan or a mortgage, it might just be in the whole packet of paper, all 3 pieces as you're going through that process. So something you want to look for and potentially pull out and review. And it's important to be aware of that timeline because, again, you do have the right to opt out if you no longer want to pursue that product. So you want to be aware of where that information comes in. One of the best things you can do to keep your credit healthy is to reduce the amount that you owe, right? Your credit limit is the amount that you owe, the amount you're approved for on a credit card or other lending financial product. And you can't borrow over that amount, but you can still potentially have a balance over that amount based on interest and fees that can accumulate should you be delinquent or borrow enough that eventually the interest exceeds the amount you borrow. Generally, we recommend 30% what's called credit utilization, or really just how much of a balance you maintain in relation to how much you can potentially borrow. So for example, if you had a $100 credit card, we would recommend that you don't carry more than 30% or $30 balance on that particular card. That's generally considered a healthy level of maintenance for that particular field. And then how do you ultimately build good credit, right? You borrow money and you pay it off. on time. This is extraordinarily important. Part of what goes into building that credit score, the two highest categories are your payment history, which represents 35% of it, and then that utilization, which represents 30% of it, oddly enough, 30 for 30. The reason this is so important is they can, just as they can very positively impact your credit by building that trust and using credit responsibly, they can also detriment it very, very quickly, right? Certainly, if you miss a payment, I know that I've had my own several different mechanisms for monitoring my credit, and I've had little notifications pop up and go, whoopsie, you missed a payment. That has an immediate impact, where building that trust takes much more time, and seeing the positive ramifications to your score takes a long time as well. Now, there's a few ways that you can potentially look at, reducing the amount of debt that you have if you need to do that. Two of them are listed here for you. There's the high cost debt first method and the snowball method. High cost debts first just really means prioritizing your high cost debts first, looking to pay those first. Where snowball prioritizes your lowest balance debts first. It's not that we're recommending one over another. It's just these are two options that are potentially there. And there's several others that exist as well. The point is that there's no secret to it, right? The real secret to establishing or reestablishing your credit is to manage it responsibly over time, using the method that best fits your individual circumstances. And one of the really cool tools that iGrad has available is called their credit card paydown calculator. And that's what you're seeing on the very right-hand side of the screen. It'll show you several different methodologies, including a third option, that you might utilize to pay down debt, and ultimately what that looks like over time with consideration for your individual priorities. And that's one of the things that iGrad really promotes, is having that customization so that you can meet your individual needs. Now, when we talk about debt, I do like to make sure we talk about student debt, right? Since we are talking to a group of students. The first type of debt that we'll talk about is federal student loans, and those are offered to eligible students through the U.S. Department of Education's Financial Aid Federal Direct Loan Program. And the Department of Education is your lender. And there are several different types. The most common are subsidized, unsubsidized, and plus loans, with the difference being one, when the interest becomes your responsibility, and two, the requirements for receiving it. But they're all considered federal direct student loans. And there's also something called direct consolidation loans, and that's still a federal student loan. However, it's something you might utilize after having borrowed. And the idea is it's kind of just kind of getting a brand new loan that pays off the old ones. It's a big reset button. It collects all of it, almost like refinancing. And that might be an option for students that are looking for some long-term planning. Now, private student loans are non-federal loans made by a lender like a bank or a credit union, a state agency, or a school. So really more traditional financial institutions. And their terms and conditions are going to vary based on the way that they assess eligibility and their individual criteria, the types of products they offer, all of those things we mentioned earlier. There are some discontinued loan programs that some students may still have, including the Federal Family Education Loan, or FELP program, and the Federal Perkins Loan Program. I bring them up because there could still be students in repayment of those types of loans. So if you have borrowed, these are very likely the types of loans you may have seen. There are some individual lending opportunities for different programs. I know nursing students have potentially what's called the NSL program. So there may be other things there as well, but these are the main ones that you might actually see. Now, one of the most important things with this is actually knowing what you've borrowed, right? Being aware. Student loans are not terribly tactile, right? It's like cryptocurrency. We don't see where it goes. It doesn't feel real. Same idea as a credit card. So that can be a struggle for a lot of people. The nice thing is you have the capability to review that on studentaid.gov, which is the Department of Education's federal student aid website. And there's a link to that here for you. It's called your student aid summary. Now, while there's no centralized database to monitor your domestic private student loans, so any US-based private loan you may have borrowed, you can get that information by reviewing your credit report. And one of the really great tools that I have here for you is how interest is calculated over time on federal student loans, or really any type of daily interest assessment. And I do see we had a question pop through. We will be sharing this PowerPoint, and it will be hyperlinked, so you'll have all of the resources that are available through this as well. Now, one of the great features within iGrad in conjunction with that student aid summary, which is partly what you're seeing on the right-hand side of the screen, you can actually download a CSV version of that file of your student aid history and put it into iGrad. The nice thing about that is iGrad has a mechanism where it reminds you every once in a while to go through that process. So as I mentioned, student loans aren't terribly tactile. We aren't really, the type of people that feel that type of money. A lot of us. I struggle with it myself. That's why I'm so aware of it. This puts it front and center within your iGrad profile. iGrad really does want to serve as a one-stop shop where possible, and if you choose to use it. So it lets you take your student aid information and every once in a while pop it into your iGrad account. And it'll give you a reminder to do that about every 3 months. And this is just a little step-by-step process on how you do that. Now, the way that student loans work, okay, step one, you're awarded and subsequently choose to borrow, let's say, a federal student loan in this circumstance, right? You complete the appropriate documents to receive your loan, like entrance counseling and a master promissory note. You want to keep those in mind for a later discussion. And you might have completed them previously, so it's not always a requirement to do them at every juncture. Though I do have a slide in this presentation on when those are accepted. This way you have it for reference. The nice thing too with studentaid.gov, when you log into that summary information, you can view previously completed documents, okay? The reason this becomes important is we're going to compare these documents to a traditional credit process. This way you kind of have an idea on what those look like in that TILA process, the required disclosures. Now, step two, your loan enters in-school status, which means that you are attending at minimum a half-time enrollment status. And it'll stay that way until you either graduate, withdraw, or fall below half-time enrollment status. Okay. You'll then be requested and required to do exit counseling, which is a lot like the entrance counseling that we'll look through. It really just talks about your rights and responsibilities as a federal student loan borrower. Though the exit counseling has some additional, for nerdy me, fun stuff in it. It talked a lot about the different repayment options that are available to you and how you can best leverage them to your individual circumstances. After that, your loan will enter grace, deferment, or repayment, depending on your individual circumstances. Most of the time, you do not have to start repaying your federal student loans until 6 months after your last day in school or you drop below half-time enrollment status. And if you go back to school within less than 6 months, you get to keep that 6-month grace period. That's why we don't see us lose it over the summer term. Now, why do we want to talk about this today, right? This is ultimately the steps that cross into the comparative process. We have pre-step one, you do your FAFSA, the free application for federal student aid. Okay, step two, you do your entrance counseling, your master promissory note, as they provide critical information about your rights and responsibilities as a student loan borrower. And they must be completed before receiving your loan. That's not unlike the TILA process. You are given the opportunity to review before you ultimately start receiving funds. The biggest difference is that TILA is specific to financial institutions outside of the student loan program. So this is just going to be comparative so you can kind of see how they work together and you can use the information to better understand both. Now, step two, you use the funds lent to you ultimately to pay your educational expenses through an unsecured debt, right? We can't repossess your education, just to give an example of that type of debt. Your servicer or the company responsible for administering your loan sends several notices and are sent during this time to keep you aware of your obligations, right? So we have the information that you are required to do, but we also have the company that ultimately is responsible for sharing information with you and administering your payment, sending you information as well. After ceasing to be enrolled at that half-time enrollment status, your counseling document reiterates your acknowledgement of your rights and responsibilities as a borrower and provides valuable information about repayment. They actually give you a chance to kind of go through a mock budget, and it'll talk about the different repayment options that are available so you can look to choose one that makes sense for your circumstances. Step three, your loan goes from in-school status to grace, deferment, or repayment, and the repayment plan that you chose during your exit counseling becomes active. So you do have the opportunity to change it as long as you're a borrower in good standing. So this is the typical federal student loan process. Here, we're going to compare it to the TILA process, okay? What you see on the screen are exemplary credit card application, solicitation, and account opening and statement examples. The very first one you'll see, a lot of them look very, very similar, and that's very, very common, certainly in the credit card realm. It talks about that APR at the top left of the screen, and then further down, you can see some of those fees that could potentially be incorporated into that APR. So now we get a better idea of what that actually looks like, right? You'll also see that there's several different interest rates listed on it because this is pre-applying. These are disclosures. So it's not anything that you've necessarily committed to yet, nor have you actually had an application go through just yet. These are the potential opportunities available to you. You'll also notice that they mentioned that this is a variable APR. That's the blue highlight that you're seeing on that screen towards the mid left image. Okay. You'll also see at the very bottom, it talks about how we calculate your balance, right? It tells you how they assess interest in relation to the amount that you owe within that 30 to 45-day credit reporting cycle and your billing statement due date. So all of that is made available to you in advance. This way you have an idea as to whether you even want to pursue this as a potential opportunity for a financial product. Moving into the account opening sample, like I said, almost identical. The big difference, right? We now see that this has got one interest rate on it, excuse me, annual percentage rate on it. It's the one that applies to you because you've gone and applied for this product at this point. You haven't said you're taking it, you have to accept it. However, this is actually what you might see in those circumstances. So you can do a comparison to what was initially offered to you and then take a look at what you actually have been offered and see if it's ultimately something you want to utilize. I also do want to point out, it does have on both examples how interest ultimately gets paid and the assessment of that in relation to that billing statement as well. So you'll see that kind of in the paying interest section in the middle. And on the first document, you'll see it under the how to avoid paying interest on purchases section. So you can see how it relates to the billing cycle. And then on the right-hand side of the screen, we have a periodic statement. This is what your bill looks like, right? Ultimately, what you're going to see here, and I'm going to apologize, my eyes are not what they used to be. So I'm just going to make this a little bigger on my side to help out on that. You'll see that there's all the different payment information that's associated with this particular statement. It also talks about how you may have been assessed a late fee based on those terms that were laid out initially and the reason why, and how long it will persist for. And that it could potentially be indefinite. So these are all things that you've been provided in those previous disclosures, but they're now real. This is a product you haven't been using. So this is really important information to understand in advance of obtaining any type of product. Now, if we put that to the next comparison, this is our student loan program, right? These are your entrance counseling and master promissory note documents, as well as the application for financial aid. That step one, right? The first one is that free application for federal student aid, the FAFSA, and that's your application for any type of federal student aid, including federal student loans. It doesn't designate a difference. So you actually wind up applying for those first, right? However, just like the other process, you cannot receive them until you have your entrance counseling, sometimes called an entrance interview, completed. It talks about the conditions of your loan, of what you might borrow, including when your terms could potentially change, your rights, your responsibilities, all of those things that were outlined in those pre-disclosure documents for the TILA process. It also shares when you need to do that requirement and talks about your acknowledgement and understanding. The imagery that you see here is the PDF version because it lays out some of the topics that are discussed, but by far and large, you will do that electronically. Now, your award letter or your offer or your package provides the amount you may borrow, or after accepting the amount you agreed to borrow. So federal student loans are a little different in that the eligibility comes, as some of us may know, from the financial aid office. So we share that with you. That ultimately is the maximum you can borrow based on our determination of your eligibility, right? So you're not really seeing that piece in the first end of it. You get it kind of in the middle. But it still all happens before you actually receive any type of loan project. And then the last one is a snapshot of your master promissory note. As you can see, this is where you promise to repay your loan. This is also called a loan agreement, and it obligates repayment of your loans within the applicable terms and conditions, okay? What you're acknowledging here is that you understand that you could also potentially receive, in addition to understanding these terms and conditions and agreeing to them, more than one loan under this master promissory note. So that means not just for one in particular year, but also as you continue your education. These are valid for about 10 years or so if you ultimately borrow off of them. So this is also something that you want to be aware of as well. This is unique to federal student loans. It's not something you'll see in most traditional lending products. Normally, you need a new agreement for every product you utilize, and you'll see all of those fund disclosures. But this is something that's kind of unique to that particular process. So I did want to highlight it for you. And these are all documents that are required in advance of actually receiving funding. So you can kind of see the parallels in the information that's being shared so that you can compare it to what you might see in more consumer lending products. And just as a little fun note, you'll see that that snapshot does indicate that this is page 2 of 14. This is a long document, but it's worth reading and important that you do. Now, we're going to take another comparative analysis and take a look at some of the credit card application solicitations and account opening statements that you'll see with private student loans. These look much more like the TILA documents we saw in the credit card example, right? We see that blocky lettering. We see all of the different types of information that you have in those different disclosures. And that's ultimately what you'll see in a more traditional consumer lending product. That's exactly what this is. And I won't go through it in all detail because there's a lot on this particular slide. But on the left-hand side of the screen, this is our, solicitation. We haven't applied just yet, which is why we have a range of interest rates. It also shows you exemplary information at different rates over different periods of time using an exemplary $10,000 loan. It also makes the recommendation that you look to federal loans first because it may be something with better interest rates. In the middle, we also have kind of that secondary disclosure we talked about. This is your application, as well as notices to the applicant, right? How much you can potentially borrow in its relation to what we call your cost of attendance, which we'll touch on. But also it shows you what you're certifying as you go through this process when you apply. And then before you receive the loan, you ultimately get an approval disclosure, which shows you your individual loan, your right to cancel, the itemization based on your repayment terms, and then subsequently the statement that goes with it. So you'll receive 3 different sets of disclosure information for these types of loans, including the final, which only happens after you've accepted the loan. Again, giving you the right to cancel. Just to give you some examples here, this is going to show you a little bit some of the federal student loan documents in association to credit card account opening statements, right? On the left-hand side, this is kind of like your account opening loan disclosure. This would be something you got from your servicer, the administrator of your loans. And it's going to show you the totality of the loan and also inform you that any adjustments relating to the total amount and disbursement will come from your school. You also get a disbursement notification, which is the middle. Okay, that disbursement notification lets you know exactly how much has been sent to a school on your behalf. And in the middle, how you can potentially cancel. Very, very similar to that last little piece. And you actually have access to a lot of the documents we talked about, like entrance counseling and master promissory note, by logging into studentaid.gov under the My Documents section. And then the exit counseling, again, before you go into repayment, it's an added level of information sharing, which you can also see through the My Documents section. It acknowledges your rights and responsibilities, as well as you update your contact information so that they have accurate information to get in touch for you while you're in repayment. So they're not identical processes, but you can see parallels between them so that you have the capability to better understand financial statements in general. Now, just a couple of timelines as far as these documents go for reference. I won't touch it in detail, but each document has its own parameter in federal student aid for how long it is valid, including your entrance counseling, your master promissory note, as well as any credit assessments related to a graduate plus loan or a traditional plus loan for a parent. So please do review this so you have the opportunity to look because it will outline when you can expect to receive those disclosure documents and when you may need to do them again. Now, with any type of lending product, it's really important to understand what repayment will look like because delinquency, which is just past due or default, are detrimental to your credit. Okay? Federal loans have some really unique repayment options that can be based on your income or could potentially extend the time frame in which you choose to ultimately repay, going from 10 years of standard to as much as 25, depending on the plan you choose. So there's a really great resource here on that repayment information so you can have a better idea as to what it looks like, as well as the studentaid.gov website for this information as well. Now, private loans, on the other hand, that information is going to come directly from the lending institution. There's no aggregated space, as we mentioned earlier. So that's why it's extraordinarily important to read those disclosure documents for those types of loans. One of the unique things about federal student loans is that these types of repayment plans are built into the terms for you as a borrower. This is something you're entitled to as long as you're in good standing. Private loans very likely will not have that. So something to look for in those disclosures. Now, the best way to manage debt, right? There's a lot of information here and it's a lot of reading. Yes, it's not fun reading, of course not, but important reading. How do we really get it at the onset, right? The real key is to minimize your debt, not just understand it, right? We don't want to borrow more than we need. So we want to use budgeting to determine, if we even need a student loan to help support us during our periods of academic study. One of the really valuable tools for doing that is your cost of attendance, which is available on the Student Financial Services website or your school's website, depending on which school that you're at. And it's really just a guide of what school may cost over a period of time. Okay. You can also look to things like the university's payment plan, which has no interest associated to it, as well as your own personal financial resources outside of student aid, such as working income or employer benefits, family resources, to help minimize anything you may borrow. As far as looking for non-repayable fund sources, scholarships, grants, things along those lines, you want to make sure you're visiting trusted sources. And one of the best indicators of that is whether or not they ask you to pay. If they do, might not be the best place to be. And one of the really great things that's available to you through iGrad is they have an extraordinarily robust scholarship search engine. And there's information for that for you on the side of the screen. Okay. If you do find you've been awarded any type of assistance, whether you're a new student or a continuing student, you do want to let the financial aid office know, partly because we want to help you minimize your debt. We may have to make some adjustments, right? It's great to get some extra money, but if it just results in it going back in your pocket instead of reducing your debt, and that wasn't what you wanted, it's not terribly helpful. So you definitely want to let us know. Okay. So we're going to talk a little bit about budgeting, right? And the reason we do that is if we want to minimize our debt, we need to know exactly what our finances look like, as we talked about earlier. We have to know what's important to us to understand our needs and wants. We have to evaluate our income and expenses and then set appropriate goals. And then we can make a spending plan, something that takes our finances from now into the future. And one of the most critical steps is to assess, reflect, and adjust, right? When we talk about things like values, beliefs, and attitudes and how they really play into financial wellness, we need to make sure that we're considering them frequently because they change, right? Values are pretty core and beliefs are too, but the way we interact with things isn't. And ultimately, our choices can change over time. So this assessment is extraordinarily important in this process. Let's touch a little bit on Maslow's hierarchy of needs. I don't know if anybody else is familiar, but several people that we've talked through in these presentations are. When we talk about needs or wants, we have to really think about our individual values and beliefs, right? When we think about a need, we understand physiological, those are those basic core needs that everyone can have. However, we then fall into the less critical in the traditional sense needs, right? And wherever you land on this this pyramid will influence that. So the lower parts of this pyramid ultimately have higher priorities, but at our core, we're seeking to fulfill all of them. And we need to think through some of the questions that we have here on the screen to better understand that. So when you have something in your hand to purchase and you take a look at it and ultimately decide whether you're going to buy it or not, you can ask yourself, what need is this expense filling? How can you fulfill that need without it or with a less expensive alternative? Really great example. I was just speaking with a friend of mine and mentioned that I want to get a pair of sleep headphones, but that I'm a bit of a brand snob and I want to make sure I get Bose. That's not helpful. I just need something that does what it needs to do if I'm choosing to get that. Now, is it even a need? Probably not. I have a perfectly good set of headphones. It's just a little uncomfortable to sleep in. So Anybody in any position can assess that particular question differently based on the item they have in their hand and how they understand themselves within this pyramid, excuse me. And if you're still unsure, right, if you've gone through these questions, you just really can't tell if it's something you need or want, because again, that's very subjective. Look to the people that know you best. Speak with a friend, family member, or a trusted advisor, and they can help you to better understand whether or not this is something you can function with, or if you're best waiting to, let it land a little higher on the pyramid. Now, in order to actually get through setting up needs and wants, we have to talk about the want side, right? And wants, really what they are at their core, are goals, right? We don't have to have it today. We've assessed something like those headphones as a need or a want and decided it's a want. That means we can plan for it, okay? One of the really great tools that are available to do that are SMART goals. And the structure of that is that you're making goals that are specific, measurable, achievable, realistic, and timely. We see this used in business a lot. We see it used in the academic side of things every once in a while. It's really great just for any type of goal you may be trying to strive for. It helps you assess how you're going to get there. Now, systems, on the other hand, are the actions you'll take to fulfill and meet each piece of those SMART goals, right? We think about running a 5K as an example. You can't just get up and run a 5K tomorrow. What are you going to do to make that happen? Oh, on Monday, Wednesday, and Friday, I'm going to do 20 minutes of cardio. I'm going to start by walking for 5 minutes, then jogging for 10, and then walking for 5. And then after 3 weeks, I will do this. And then after 5 weeks, I plan to do this. That is a system. And those systems ultimately will work for you if you can land them within that SMART goal framework. One of the things I like to do, I tend to write my goals down and then funnel them so I can see the big picture and then better identify the steps that go with each particular goal. Sometimes you might need to disaggregate them, right? If that goal is way too big and it's just too hard to get to that picture and you're writing all of these steps down and you ran out of paper, ultimately that might tell you need to start with something smaller, something a little bit more tangible and realistic. And then we can make bigger movement later on. And this falls within any financial goal or really any goal that you have. Basically, your goal tells you where you're going, and the system tells you how to get there based on what you do today. Now, when we think about this in the context of trying to plan our finances as a student, right? I mentioned earlier, one of the really great tools that are available to you is called your cost of attendance. It might be called your COA or your budget if you're speaking with your financial aid office. And it shows you some of the direct, which are the actual assessed costs that you can anticipate, as well as indirect costs, the ones that maybe you have to pay for somewhere outside of the university in relation to your education. You'll generally get it with any award offer that you receive, but it's also available on the Student Financial Services website. And you can also contact your financial aid office for additional details. But on the screen, you'll see on the right-hand side, we break down what direct costs are, those actual things that are charged by the university, where the indirect costs, those other things that go with school. It's important to note, though, these are not necessarily all of your expenses, right? This is about getting a framework for what costs are while you're in school and putting in context with your actual expenses. So the easiest way to think of it is actual versus approximate, right? The actual cost of your specific financial obligations, your income and expenses, with the representative information that goes with your cost of attendance. And you can use that plan. Just to give you an idea as to what that looks like, ultimately here we have a snapshot of what a typical budget might look like, and that's actually a tool that's available from iGrad, and I will make sure that's provided to you in this presentation document and the presentation materials as well. You'll see the cost of attendance information that may be available on the Student Financial Services website. And then you also have your bill, right? We do have to remember that cost of attendance is a representation. There are maybe things that we don't necessarily know that you will be assessed when we create cost of attendance. A good example of this may be individual course fees, right? So this is meant to be a guide for sure. However, you can see that that cost of attendance information overlaps with several of the key items that you need to include in your budget. We have things like room and board, that's your housing, your personal expenses are in there as well. You also have utilities, which falls into the board side of things. Medical insurance is there. Telecommunications, your phone, that's a utility. Transportation. So you can see how this can be very helpful in planning your expenses while you're in school. Just to share some of the more commonly forgotten items that go along with planning your expenses. A lot of our understanding of these are a little abstract, things that go along with, say, costs associated with driving. We all know that we have to pay for gas, let's say, if we're driving a car, but maybe we don't think about how we have to plan for the flat tire that pops up inevitably once every year that I actually personally have to deal with because it's sitting in my driveway. Another example might be extra medical charges. Those are costs that pop up very unexpectedly for most people, certainly those within the realm of higher education and post-secondary students. You're not really expecting a medical problem for most of us. So you want to be aware that that could potentially pop up. Automatic recurring subscriptions. I got this one actually myself not long ago. I had something I did an annual subscription purchase on and completely forgot about it because I didn't see it going through my statements all the time. And then poof, $100-something for a subscription in the middle of February that I was not planning on. Now I had reserves, I was okay, but at the same time, it's better to be aware that that's coming in advance. Okay. Some of the easiest areas to trim, should you have any type of concern, are listed here for you as well, and how you might assess whether or not you can actually trim it. Personal care, gifts and extras, and memberships and subscriptions are very, very easy places to potentially see that reduction. I know for me, I tend to go and get highlights or balayage, fancy term. And that can be a very expensive process. I have foregone that certainly because I don't see people as much in person right now. But at the same time, I decided I didn't really need to be spending that amount of money on it, given what I was hoping to achieve in my other areas of financial goals. Now, how do we really let our spending plan, right? That document that takes our current finances and looks to the future and where we want to go. How do we make it meaningful and build meaningful goals, right? If we were to sit and assess our spending plan and our budget and our expenses, right? We review each item and then we identify any unusual or unexpected values. And then if we have a comparative measure for a previous period, because you do this more than once, it's a cycle, we would then take it and compare it and see if this is something that's just kind of unique to this particular month, or is it something I need to plan for in the future? In this particular example, you'll see that this is a student budget, right? In the other section that's highlighted in the middle of the screen, that 7713, that's tuition and fees for spring, okay? That's what this person is anticipating to spend on that. And this actually came from cost of attendance figures for one of the schools of Columbia. We also see that this person's not planning for an emergency fund, though they are putting in retirement assistance, which is great. And they have a part-time job. They do have some money coming in outside of things offered to them through the school. However, we do see that they're utilizing student loans. That's up at the top of the screen in the pink circle that you see. And that number is usually the pretty typical amount you might see as a graduate student at the university for support. And they have $590 left over. So if you're looking at this in a traditional sense, going, oh, I've got money left over, my budget is fine. However, what is this really doing for us in the long run? We've kind of looking like we just borrowed the amount of money we were offered in a student loan, and there's a lot of money sitting left over at the end of the month. Instead of letting it go to waste, right? What we can then do is look to repurpose our budget and give it meaning and purpose. What we've done here is we've reduced a couple of places, right? Dining and going out and clothes. We didn't really need to be spending that much there. So as we were going through and assessing, we adjusted. Same thing with utilities. Maybe we lost the subscription that went along with our phone bill. However, you'll also see that the student loan amount has reduced. By doing that, we've been able to start building an emergency fund, right? So that should one of those unexpected expenses pop up, we've got a bit of a plan for it. And while it doesn't seem like it's a lot of money, right? It ultimately comes to, going from $590 down to 163 that we have left over every month. You can see that after 5 years, if we continue to put that $150 into an initial and investment account of 427, the difference between the two, ultimately we'll have $9,446 at the end of 5 years. And that's in a traditional money market, right? A little higher than a checking. So it's not necessarily just looking at the number. You want to make sure that you're looking at the behavior, ultimately what you're doing in the long term. Setting that place for saving, if you don't have to tap into that fund in over 5 years, can get you nearly a $10,000 benefit just by spending a little bit of time analyzing your budget. Really, the most important part here is building up your money self-esteem, the idea of self-efficacy. This looks like a lot, but you don't have to do all of it at once, right? The idea is to start small, achieve escalating levels of accomplishments because it builds your natural momentum. You'll find that this helps to minimize some of the stress that you may experience related to finances, or if you're not sure where your source of stress is coming from, identify if it could be finances. And one of the best practices for getting good at this is to observe others, right? Have a positive role model that helps you better understand what this process should look like. That's one of the really great things about iGrad and the way we build these presentations. They're meant to be resources for you so you have something exemplary to look at. And then once you understand that you can succeed and know that you've seen someone else do it too, you're more likely to trust that you can continue to do that yourself. And the study on the right-hand side of the screen of 968 emerging adults really serves to that purpose. In their assessment, they found, the researchers, that higher perceived financial control and more positive financial attitudes and just more exposure to financial education ultimately was predictive of a gain pattern associated with the most progress towards self-sufficiency, their stability, their career status, and their overall well-being. So this again takes us into that larger well-being discussion, how just knowing that you can do it by doing it and watching others like you do it is a benefit to you. And just to touch on some of the things that might influence the way you engage with finances, there are a few money, what we call scripts, that can potentially occur within a person's personality. Money avoidance, worship, status, and vigilance, and the descriptions of those are all listed here. The idea is these are kind of big overarching themes that exist within people's engagement and their behavior with finances. So if you're struggling, it's not just you, right? You're not unique in that struggle. These are things that several people suffer from, and therefore you want to be aware of and look for. And to help you better understand that, iGrad has a really fantastic money personality assessment. And basically, you just answer a couple of really quick personality-based questions, and they give you feedback to help you better engage with your finances, utilizing your strengths and where you may find challenges. And in my instance, because you're looking at mine, in my 40-page document, one of the things I got feedback on is that I can be a little relaxed with finances. And yes, that was a mirror. It absolutely was. Uh, so some of the strengths that they outlined is that I might not, be afraid to make an investment necessarily. I won't have risk aversion. However, I also might be a little impulsive, I might not look all the way through. One of the recommendations they made, you'll see number 2, is to slow down, take a beat before you buy. And I used this personally recently. I definitely, in this environment that we're in, had some struggles with getting my Amazon account a little too frequently. Uh, so as the boxes were starting to pile up at the house, I said, okay, you really need to do something about this. This is too much. I got to realize that Amazon is built to ultimately engage with Trista in the store of Trista, right? It's not like going to your local department store where everything there is kind of made for a broader audience. They know exactly what I'm looking for, and I know I want to buy stuff. So if I can wait 2 days for something to get to me via a box, I can most certainly wait 2 days more to decide if I really need it. So I said, take a beat, slow down. Anything I go to buy goes in the cart, and I wait 2 days. And if after that I remember it's even there, maybe I'll consider buying it. But if it's not, I can let it go. Just get it out of the cart because clearly I didn't need it that bad. So this is ultimately a tool that can help you better understand the way that you engage and certainly help you identify any of those potential money circumstances we mentioned on the previous slide. So again, the most important part of this is to know that you've got this, right? Self-efficacy is so extraordinarily important. And as we think about self-efficacy, we're really starting to talk about the things that you're seeing here. That evaluating and adhering to your spending plan reinforces your capability to succeed and provides a factual foundation for making positive, long-lasting changes. And this applies to your goals. It applies to building your financial literacy toolkit and acting with intention, and ultimately that your commitment to invest in yourself reinforces your capability to succeed and provides a factual foundation for making positive, long-lasting changes. And we note the study again that helps to personify this. Just by doing, you'll do it again. And seeing yourself be successful is so extraordinarily important because that minimizes stress as well. Now, just to end our conversation, I do want to point out the information on iGrad. This is actually a snapshot of your dashboard, and this is the free web-based financial literacy platform that's provided to you as a student at the university at no cost now and after you leave. So anything you provide in this platform is free to you, and you'll have access to it for as long as it's available as iGrad exists. So this is a little snapshot on what that platform looks like. It has some of the tools we talked about today here that you can get right through your dashboard. And as you go through this process, you'll also see they have a dedicated set of resources for COVID. This gives information on how to avoid things like financial insecurity, as well as where to get support when it's needed. So you have that as a resource. And there's also information here on some of the other resources available throughout the university and through the Department of Education on following the pandemic. In the meantime, I do want to share the information here that has instructions on creating your account through iGrad. You'll have that as part of the presentation. And open up, I know we got it just on a minute over on time, but I do want to thank everybody for coming. And if you had questions that I wasn't able to address today based on time, please do not be afraid to contact us. And if you want to share information directly with the feedback that you're providing through University Life, please share what you'd like to there as well. We also communicate with each other to make sure that we're creating presentations that matter for you. So thank you again, and I'm going to go ahead and pass it back to my colleagues in University Life to wrap things up. Awesome. Thank you so much, everybody. Again, please see the information in the chat, and if there's anything that you need, do not hesitate to reach us. I appreciate you all staying the extra couple of minutes, and have a great day.